and gentlemen, welcome to the presentation of our consultant group. This is Jack, our analyst, Tim, who was responsible for the acquisition strategy, Kate, our financial expert, my name is Laura, who is responsible for the integration strategy. We will introduce you to the solution, how to successfully acquire Mobile One operator and how to integrate it with the software house.
We will show you how to put together different ingredients to get the best cocktail that generates 40% annual return over a 5-year period. The mobile industry in Singapore favors for operators that will offer innovative 4G services. But what are the major environmental forces acting on the group? Technological life cycle is very short, so a successful company has to be fast and innovative. Strong competition lowers the prices of basic services. Customer preferences show that extra profit can be achieved by selling value-added services. So we conclude that to achieve success in the mobile market, a company is needed that is the first to offer high-tech 4G services. Mobile One is the number 3 mobile operator in Singapore in 2008 with 26% market share. 70% of it is owned by government-related companies. The profit and the revenue has decreased since last year. It has the capability to introduce 4G services. The software house developed a high-potential software which needs testing. This company is owned by Sadiki Capital. Red Sea Investment is focusing on telecommunication investments and is looking for the next target for its free capital. It has been cooperating with Sadiki Capital. Sadiki Capital has expertise in the telecommunication industry and also has investments. It is also the owner of the software house and has been cooperating with Red Sea Investment.
After selecting the ingredients, the next step on our way to making the perfect cocktail is to pour them into the glass.
M1 is a publicly listed company, so there are two opportunities to acquire it. Whether go in an open market transaction or go with a privately negotiated deal. We group 3 criteria along we will make our decisions. First of all, the size of the stake. If the size of the stake is larger, the privately negotiated transaction is better to go with. The second criteria is the speed of the transaction, speed of the deal. In this case, we found, according to the former transactions, that the privately negotiated transaction would be better for this acquisition. And last but not least, the ownership structure of the company is also a determining criteria. We found that there are only a few owners with a relatively high stake of shares in M1 Ltd. And this way, it also supports to go with a privately negotiated deal.
The question of integrating 2 companies is very similar to a situation when we are preparing a cocktail. We identified 3 alternatives regarding the integration of Mobile One and the software house. The first alternative is that we put the ingredients into one glass and shake them together. If we totally integrate the 2 companies, we are facing many difficulties. Integrating cultures, management may take a long time and involves a lot of risks. If we pour the ingredients into 2 different glasses, we cannot enjoy the real taste of our cocktail, just like in the situation of our companies. If we keep them separated, we cannot use the synergies and the cooperation will face barriers as well. While the advantage is that if we need to exit the business, it is quite easy to sell the companies individually. The third alternative we identified in making a layered cocktail out of the ingredients. We put them into the same glass. We do not shake them, but leave them in 2 layers. We can integrate Mobile One and the software house as 2 divisions of one company. This way we keep the advantages of the above 2 alternatives. After evaluating the alternatives for the integration, we suggest the third one. This will ensure efficient cooperation between the companies without having to face the major risks of a total integration.
And now, let's see the most important stakeholders.
As the head of Red Sea Investment, the most important is the financial return of this project.
I totally agree, but I think Sadiki Capital should also show its commitment by investing a substantial stake. For example, by offering the software house to merge with the M1 company.
Exactly. This way we can ensure that we have the same goals and that we can trust each other.
Excuse me, what are the concerns of the Singaporean government about investors buying M1 mobile operator.
We want to ensure that jobs of present employees are safe, subscribers receive a good quality service for a fair price, and that a next generation national broadband network plan is also achieved.
Thank you.
Yeah, well, of course, there are conditions upon which Capital Group is willing to sell its stake in M1. Most importantly, the price paid for our shares. However, we know that we cannot expect this high price due to the M1's performance in the last couple of years. But our cocktail is not ready yet. We have to pay attention to the smallest details as well. That means we should garnish it and serve it in the proper way. Now let's see the details of our recommendations.
The investment structure is to establish a trustworthy relationship between Sadiki Capital and Red Sea Investment in order to govern the new company. Both companies will invest in the project and they will receive ownership in a way that their interests are aligned. Until now, both companies made financial investments, but this is a strategic investment as the focus is on the synergies between Mobile One and the software house. One of the key points of the decisions is that 20% of the investment is paid by Sadiki Capital in the form of the software house and the rest is financed by Red Sea. The first step among the actions is to negotiate with Red Sea and then evaluate the mobile operator and the software house also. However, Red Sea might not accept the software house as 20% of the stake. In this case, Sadiki can supplement its invested capital with an extra 5% money.
We suggest to acquire a stake of 70% in Mobile One company by a private negotiated transaction. We suggest to start negotiating with the two Singaporean firms and also at the same time with the Singaporean government itself because of its regulator role in the industry. We believe that the fair price for this stake will be around 1.1 billion Singaporean dollar. We based our calculations on the current market price and we add some premiums due to the synergies we're gonna exploit in the future. We believe that this is probably the cheapest and easiest way to acquire a controlling stake in M1 company. Based on the former transactions, we calculated that signing a deal with Capital Group and SPH would take 2 to 4 months. There are some barriers, mainly because of the additional aims of the Singaporean government, such as the employment rate and the new program of NGMBM. But we believe that with giving guarantees that there won't be layoffs and showing commitment to support the NGMBM program, these barriers could overcome.
In our solution, we propose a divisional type of integration with cross-divisional management teams that will ensure successful cooperation and communication with the software house and the mobile operator. Our priority is to start testing the software as soon as possible. By integration, we have to focus on integrating the functions that are essentials for testing the software, but at the same time we have to maintain the core competencies and culture of each company. During the implementation, some risks may emerge. For example, top management might be unable to handle the integration. In this case, we will have to assign new managers for Mobile One or Sadiki Capital or either Sadiki Capital's invested companies. With this new strategy, Mobile One is going to be the most innovative mobile operator offering top technology services in Singapore. This will gain the company a market share of 45% in 5 years.
A proper exit strategy is always essential. We estimated that in the next 5 years, Sadiki Capital and Red Sea Investment would be able to reap a 40% annual return from the enhanced Mobile One sales by offering 4G services. The initial investment of 1.1 billion Singaporean dollar should return after 3 years, otherwise Sadiki and Red Sea should quit the investment. We suggest to split the mobile operator and the software house into 2 separate firms because it is easier to sell 2 smaller companies. However, it would be still too difficult and costly to sell the stake on the open market, so we suggest a privately negotiated transaction. To handle the Singaporean government's concerns, first offer them to buy the stakes. So our solution showed that it's profitable to invest in M1 and the software house. By integrating them into a divisional structure together, they are able to perform successfully on the market and generate more than 40% annual return for their investors in a 5 year period.